What are some of the key rating issues facing the reinsurance market? I'm Yvette Essen for AM Best TV in London at Insurance Market Briefing Europe, AM Best's flagship event, and I'm joined by Stefan Holzberger, Senior Managing Director and Chief Rating Officer for AM Best. So could you highlight for me some of the key trends that the reinsurance market is facing?
Sure, Yvette. I think the biggest challenge for the reinsurance sector today is achieving an adequate level of profitability. We've seen several years of soft pricing, expanded terms and conditions. The results have benefited from favorable reserve development, but what we see right now in a non-cat year for the reinsurance sector is kind of mid to high single-digit ROEs. So somewhere between, a 5 and an 8% ROE. In a good year, somewhere between a 95 and a 98, 99 combined ratio in terms of the technical performance. And when you look at the reinsurance sector and you look at the weighted average cost of capital, those averages mean that many companies in the sector are not going to be achieving an adequate return. And that has implications for their financial flexibility, investor interest in the asset class. So performance is the key issue that we see in the market. Couple that with limited growth opportunities. The industry has excess capital, and there's a real challenge to try to put that excess capital to work through growth. So we see some opportunities. Mortgage in the U.S. being an example. Cyber is a growing line of business. Terrorism coverage, we see some opportunities there for the segment, but achieving that growth and putting the balance sheet to work is another challenge for the sector.
How big a challenge is capital management for companies?
Right, so capital management is critical for the reinsurance market. Frankly, they've always been quite good at it. We see dividends, extraordinary dividends in some cases, and share buybacks in an effort to reduce that size of the balance sheet to make it more commensurate with the risks that are being undertaken for the reinsurance sectors. Also, we've had many, many years, as you know, of low interest rate environment. And what we've seen the reinsurance sector do is lower their financial leverage over that period of time and refinance debt at lower interest rates. So again, bringing down that weighted average cost of capital by introducing lower cost debt into their own balance sheets. But as things stand, there is despite these capital management activities, a very large capital cushion for the sector, and it's a challenge for the reinsurance companies to try to put that capital to work.
Now, no conversation about the global reinsurance market would be complete without talk about alternative capital. What's the impact it's having and ILS having on the sector?
Right, so alternative capital, and what we mean by alternative capital is cat bonds and ILWs, sidecars, and predominantly the collateralized reinsurance market. The demand from ILS investors for reinsurance as an asset class is really bringing down pricing on property cat particularly. So, it's been covered extensively. The pricing environment for peak zone property cat, the U.S., Japan being primary examples where these ILS investors are taking on that risk. The rates are really down below what we would consider a technically adequate level. The returns that can be generated are really not appropriate for the amount of risk that's being undertaken. Alternative capital in 2018, we expect it to reach $100 billion. It's been on a strong growth trajectory, so the ILS market is definitely fueling competitive pressures in the market. One thing that we would say is interesting, since the 2017 catastrophe losses, traditional players and ILS investors were expecting a bit of a rebound in terms of the pricing environment. We all heard the talk from Monte Carlo and towards the end of 2017 that 2018 might very well bring on a better pricing environment for 1/1, 6/1, 7/1 renewals. And as we know, that did not take place. So I think ILS investors are getting to the point where they're starting to demand an improved return, and that's probably good news for the overall pricing environment.
But with the pricing environment so difficult, it's not really a surprise then that our outlook on the global reinsurance sector is negative. Can you explain any other reasons why it's negative, and what would cause us to change it and become a little bit more positive?
Yeah, that's right. We've had a negative outlook on the reinsurance sector for several years now, and it's not due to any shortfall from a capital or capacity standpoint, right? There's ample, from a credit perspective, ample capacity, and balance sheets are strong enough to withstand very extreme events. The negative outlook is really tied to the pricing environment and the return expectations going forward. If you strip out the favorable reserve development that we've seen over the last 5 years, which we don't really feel is sustainable. It wasn't too many years ago, 3-4 years ago, when the ROEs and the combined ratios were benefiting from, on a combined ratio basis, 6 points of favorable development, bringing down those combined ratios. With the tight pricing environment, the potential for inflationary conditions in some core markets, we don't expect that kind of reserve release to benefit earnings going forward, which means that results are going to be, really constrained, and the returns are really going to be at a level that is probably going to be somewhat disappointing to investors. So the ability to achieve an adequate return is a big one. Also, finding growth opportunities is difficult in this market. So you got the intense competition, you've got the likelihood of reduced levels of profitability and limited opportunities for growth, really driving some pressure on the reinsurance segment. There are some positive aspects to the market. To your question, what might we see as in shifting that negative outlook back to stable? Since the losses of 2017, we are seeing an increased demand for reinsurance from the primary companies, so that's helping the top line of the reinsurance market. There is the potential, certainly loss-affected accounts are seeing some increase in pricing, so that's good news. Maybe a leveling out of the pricing environment for property lines, and then also a recognition that casualty lines are underpriced, and there's a need to bring those casualty rates back up to really where they need to be. So some opportunities there. It's really going to be, time will tell whether the pricing environment is conducive enough to kind of leveling out or bottoming out the return expectations that we see. One final point on a looking forward basis, and I think this is something we're going to look at carefully when we evaluate the outlook in December of this year, is kind of a coming together of traditional and alternative capacity, right? We've seen the tie-up between Markel and Catco and Nephila, Apollo's acquisition of Aspen, the Canada Teachers Pension acquiring and owning Ascot. This alignment of interest between traditional and alternative capacity could bring further discipline into the market, which would really be a positive.
So quite a few factors there to look forward to going forward, of which many will be found on AM Best's website going forward, as well as the global reinsurance outlook currently, that being negative, can also be found on our website, ambest.com. For AM Best TV at Insurance Market Briefing Europe, I'm Yvette Essen.